Now let's move on to myth number 3, which is market timing. And if you're following along in your workbook, this should be on page 8 because you're going to have some numbers to write in during this presentation of market timing. Market timing is defined as any attempt to alter or change the mix of assets based on a prediction or forecast about the future. Now, I don't like the word forecast because who makes forecasts? The meteorologists, the weathermen. And what do they have? They have Doppler radar that shows them the weather that's coming into the area, and they're only right 39% of the time. So I don't particularly like the word forecast, but that's part of what the definition is. The myth is that money managers are able to utilize market timing to effectively predict up and down markets. So DALBAR is an independent research firm that does 20-year studies. They take hundreds and thousands of brokerage accounts with $100,000 or more, so not your small, inexperienced investors in brokerage accounts that have $100,000 or more, to determine what the real returns were for the average equity-based mutual fund investor. And here's what they found. The S&P 500 index from 1991 to 2010 had an annualized return of 9.14%, while the average equity-based mutual fund investor only had a return of 3.83%. Now here's where the rubber meets the road, because we have to measure real purchasing power here. If you subtract out inflation from the average equity-based mutual fund investor's return, you have about a 1.5%, which is basically less than T-bills. So let's see actually how hard it is to time the market and get in and out at the right times. This is a chart that shows a $10,000 investment. If you invested $10,000 in the S&P 500 in January 1st of 1991 and held that for 20 years till December 31st of 2010, your $10,000 grew to $56,565 with a 9.05% return. However, if you missed the 5 best days out of 5,040 days, your return drops to 6.84 and your $10,000 only grows to $37,535. If you miss the 10 best days, your return drops to 5.34 and your $10,000 only grows to $28,288, almost half of what you would have gotten if you'd stayed fully invested in the market. If you missed the 15 best days, your return drops to 4.05 and $10,000 grows to $22,140. 20 best days, a 2.91% return, $10,000 grows to $17,747. If you missed the 25 best days, $14,436 is what your $10,000 grew to, with a 1.85% return. If you missed the 30 best days, you basically have a 0.85% return, and your $10,000 grows to $11,852. And if you miss less than 1% of 5,040 trading days, you lose money. You have a negative 1.04%, and your $10,000 shrinks to $8,118. So you can see, trying to time the market, if you just miss less than 1% of the best trading days in a 20-year period of time, you actually lose money. But most people will agree that market timing doesn't work, and we've shown that statistically and empirically that timing the market is almost impossible to do. However, Wall Street has decided that there's a new form of market timing that they can use. They don't call it market timing, they call it tactical asset allocation. This is market timing in disguise. In the first idea, you had to choose between stocks or cash, just 2 asset classes. But what they've decided to do now is add 12, 15 different asset classes. Large caps, small caps, tech stocks, healthcare stocks, biomed stocks, and they'll predict which ones will do well in the future. So if it wasn't easy to pick between 2 asset classes, does it make it any easier to pick between 12 and 15? It's similar to if you were forced to play Russian roulette. Is it more dangerous to have 1 bullet in the chamber or 6 bullets in the chamber? We know which that is. So tactical asset allocation is market timing in disguise. And some very smart people have determined that market timing is destructive to building wealth. Charles Ellis, who wrote a book that is required reading for investment advisors, said the evidence on investment managers' success with market timing is impressive and overwhelmingly negative. So now that we've covered stock picking, market timing, and track record investing, and we've determined that empirically these are not effective investing methods. They aren't predictable, they aren't repeatable, and they're forms of speculation. There's still one more myth to dispel, and that's the cost of investing, which we're going to cover in the next video.